why the government should allow the real estate market correction to proceed, and how it benefits the market. Market corrections are not failures, they are necessary reset mechanisms. Allowing the real estate market to correct without heavy intervention restores balance between prices, income, risk, and supply, which ultimately strengthens the housing system. 1. Corrections restore true affordability. Years of stimulus, low rates, and intervention pushed prices far beyond what incomes can support. A correction allows prices to realign with wages, improving affordability organically, without artificial subsidies that inflate prices again. Short-term pain leads to long-term access. 2. Price discovery requires no interference. Healthy markets need price discovery, buyers and sellers finding equilibrium based on real demand, not policy distortion. Government interference, rate suppression, bailouts, incentives, delays this process and keeps prices artificially high. Letting the market clear creates honest pricing. 3. Risk is repriced correctly. During prolonged intervention, risk is mispriced. Corrections force lenders, investors, and buyers to properly assess risk, strengthening underwriting standards and reducing future defaults. This prevents larger crashes later. 4. Capital reallocates more efficiently. Corrections flush out speculative excess and redirect capital toward productive, cash flow-driven investments. Investors shift from speculation to fundamentals, improving housing quality and stability. Speculation fades, sustainability returns. 5. Supply finally increases. As prices soften and unrealistic sellers exit, inventory rises. Distressed sales, right-sizing, and new construction become feasible again. Artificial support often freezes inventory by encouraging owners to hold at inflated values. More listings, Sean's healthier market. 6. Moral hazard is reduced. Repeated bailouts create moral hazard, the belief that risk will always be socialized. Allowing corrections teaches proper risk discipline and discourages reckless leverage. Markets function best when consequences exist. 7. Long-term stability improves. Short-term intervention often trades temporary comfort for long-term instability. Allowing corrections reduces volatility, shortens recovery cycles, and lowers the chance of systemic crises. Stability is built through adjustment, not avoidance. Bottom line, government intervention can delay pain, but it magnifies long-term damage. Letting the market correct restores affordability, encourages honest pricing, improves lending discipline, increases supply, reduces future crash risk. A controlled correction is not a crisis, it's maintenance. Healthy markets don't avoid corrections, they survive because of them.